The U.S. economy got an unexpected boost last month with a better than expected jobs report. Data shows the labor market added 130,000 jobs in January, 55,000 more than what was predicted. That's the highest number since last July. The unemployment rate also dropped slightly to 4.3%. Kristin Myers joins me now. She's the editor-in-chief of ETF.com, an economic news and analytics website. So, Kristin, what's your reaction?
I was actually really surprised to see we had such a strong start to 2026. I mean, keep in mind, just a few days ago, we had Challenger Gray and Christmas, that's an outplacement firm, saying that January was the worst month when it came to the labor market. And so I think a lot of investors, myself included, were really holding their breath before the release of this employment report at 8:30 this morning. And then to see such a strong start to the year, the unemployment rate ticking downward, we saw hourly wages ticking upward. We saw weekly hours worked ticking slightly upward, showing again that the labor market is not as weak as a lot of us had really thought.
Yeah, so how do you square all of this different data coming in? I mean, in your view, are you optimistic about the economy?
Listen, the economy continues to remain pretty strong, right? We have a lot of data that comes out here. Remember that all this data, or most of the data that we look at, is really, it's not forward looking, right? We are looking in the rear view mirror. And so there really is no accurate way to really predict what's going forward. However, we have seen recession risks really decline throughout the year. We have continued to see the US economy continue to do incredibly well. Inflation continues to remain persistent, but still far off from where we used to be. And that's even with tariffs essentially hammering the US economy. And again, the labor market continuing to weaken. And so, again, I think that this really just means that the US economy continues to chug along fairly strong. And while we do see still a lot of Americans struggling with bills and with debt and with buying things like groceries at large, however, this is still, I think, something to be pretty celebrated.
What does this mean in terms of Fed interest rates when they meet next?
That's a really good question because the Fed has really been the huge question mark for 2026. Investors right now are imagining that there's going to be two rate cuts this year. And this is one of those situations where good news becomes bad news because a really good employment report or jobs report it should be good news. However, investors really want rate cuts. The markets love rate cuts. And so when you see that the labor market is pretty strong, the Fed is looking at the labor market as a pretty good proxy for the US economy. So when the US economy continues to be strong, the Fed says, hey, we actually don't have to cut interest rates at all. And Kevin Warsh is going to be taking, if he is nominated, if he's confirmed, he's going to be taking the helm of the Fed in May. And Kevin Warsh has historically been an inflation hawk. So if we're going to hand him a reason to not cut any interest rates, that could be the direction that the Fed decides to take.
Kristin Myers, thanks so much.
Of course.